In a Texas Department of Insurance examination file, an actuary recorded a finding that should have stopped a company. Lincoln Memorial Life Insurance Company held reserve assets that consisted, almost entirely, of life insurance policies sold to a single affiliated entity. The death benefits on those policies, when triggered, would not cover the cost of the funerals that families had already paid for in full years before. The structural question of this episode is how an insurance company can hold assets that are also its own liabilities, and how a network of funeral prepayment trusts can be drained while every contract on paper appears fully funded. This is the National Prearranged Services case. The mechanism at its center is the Pre-Need Funeral Trust, and the instrument used to loot it was life insurance issued by a company the operators controlled. Begin with the legitimate structure, because the fraud is only visible against the baseline it distorts. A pre-need funeral contract is a simple consumer product. A person who wants to spare their family the cost and the decision-making of a funeral pays in advance. They select a casket, a service, a burial or cremation, and they lock in a price. The funeral home agrees to provide those goods and services when the person dies, however many years later that may be. The customer pays now. The provider performs later. The gap between payment and performance is the entire regulatory problem. The money sits for years, sometimes decades. The funeral home cannot simply spend it, because if it does, there will be nothing left to provide the funeral when the death occurs. So state law, in nearly every state, requires that pre-need funds be protected. There are two principal mechanisms for this protection. The first is the pre-need trust. The customer's money is placed into a trust account, held by a trustee, invested conservatively, and released only when the funeral is performed or the contract is cancelled. The trust grows over time. When the customer dies, the trust pays out to cover the funeral. The structure is designed so that the money is always there, segregated from the operating accounts of the funeral home, beyond the reach of the home's creditors and its operators. The second mechanism is the pre-need insurance policy. Instead of placing money in trust, the customer's payment purchases a life insurance policy. The customer is the insured. The funeral home, or a related entity, is the beneficiary. When the customer dies, the policy pays a death benefit, and that death benefit funds the funeral. The policy is supposed to be sized so that its death benefit grows over time to keep pace with the rising cost of funerals. This is the key actuarial feature. The policy must have an increasing benefit, because a funeral that costs $8,000 today will cost more when the customer dies 20 years from now. Both structures share a single requirement. At the moment of death, there must be enough money. The trust must have grown enough. The insurance policy must pay enough. If either falls short, the family is exposed. They prepaid to protect themselves, and they discover at the worst possible moment that the protection was illusory. National Prearranged Services, based in Missouri, was a seller of pre-need funeral contracts. According to the SEC's enforcement record and the related criminal proceedings, NPS sold these contracts through funeral homes across multiple states. Customers paid NPS. NPS was supposed to fund the future performance of those contracts. To do that, NPS used the insurance mechanism. Customer payments were used to purchase life insurance policies, and the insurer that issued the bulk of these policies was Lincoln Memorial Life Insurance Company. Here is the structural fact that defines the case. Lincoln Memorial Life and NPS were under common control. They were affiliates. The record in the criminal case established that the operators of NPS controlled the insurer that was supposed to provide the independent funding for the contracts NPS sold. The protection mechanism and the entity being protected against were the same hands. Consider what that means before any money moves. In a properly structured pre-need insurance arrangement, the insurer is an independent third party. It takes in premium, it sets reserves under the supervision of state insurance regulators, and it stands behind the death benefit with its own capital. The funeral seller and the insurer are at arm's length. The seller cannot reach the reserves. If the seller fails, the policies remain in force because the insurer is a separate, regulated, capitalized institution. When the seller controls the insurer, that separation collapses. The premium dollars do not leave the control of the operators. The reserves are not protected from the operators. The capital standing behind the death benefit is whatever the operators choose to leave in place. The arm's length relationship that gives the structure its integrity does not exist. That is the device. Now the architecture of how it was deployed. The flow of money in a legitimate pre-need insurance contract runs in one direction with one purpose. The customer pays. The premium funds a policy. The policy accumulates value. The death benefit grows to track funeral inflation. At death, the benefit pays the funeral. In the NPS structure, the record establishes that the flow was diverted at multiple points. Walk through the steps. Step 1. Customers paid NPS for pre-need funeral contracts. These were ordinary consumers, often elderly, who believed they were locking in the price of their own funerals. The contracts specified the goods and services and the price. Step 2. Rather than fully funding each contract, the operators structured the insurance policies so that the death benefits were inadequate. According to the criminal proceedings, the policies purchased to back the contracts had face values and benefit structures that did not match the obligations they were supposed to cover. A contract promising a funeral worth several $1,000s might be backed by a policy whose death benefit at the time of death would pay only a fraction of that amount. The funeral home director's testimony captured the consequence at ground level. When a customer died, the insurance payout arrived at a fraction of the contracted casket and service price the family had prepaid years earlier. The shortfall was real, and it appeared at the point of performance. Step 3. The difference between what customers paid and what the policies actually required as premium was extracted. The record in the enforcement and criminal matters established that funds were diverted to the operators and to entities they controlled. Money that should have funded the policies or should have remained in trust moved instead into the operators' uses. This is the looting. It is not a single theft. It is a structural skim built into the design of the funding. Step 4. The trust assets themselves were compromised. For contracts funded through pre-need trusts rather than insurance, the record established that trust assets were converted into life insurance policies issued by the affiliated insurer. This is the critical maneuver, and it is where the actuary's finding in the cold open becomes legible. The trust, which was supposed to hold liquid, conservative, independent assets, instead came to hold policies issued by Lincoln Memorial Life. The trust's assets were now claims against an affiliated, undercapitalized insurer controlled by the same people who controlled the seller. Now reconstruct the actuary's observation. Lincoln Memorial Life's reserve assets consisted almost entirely of policies sold to a single affiliated entity. Read that again as a structural statement. An insurance company's reserves are supposed to be real, marketable assets held to pay future claims. Lincoln Memorial's reserves were policies it had sold to its own affiliate. The asset side of the insurer's balance sheet was populated with obligations owed by the network it was part of. This is circularity. The insurer's solvency depended on receivables from the same enterprise whose contracts the insurer was supposed to independently guarantee. When two affiliated entities hold each other's paper as their primary assets, neither has independent backing. The structure resembles two people standing in a bucket, each attempting to lift the other by pulling on the handle. There is motion. There's the appearance of support. There is no external lift. The only real money in the system was the cash that customers continued to pay in. As long as new customers paid, there was cash to cover the funerals of those who died. The structure could perform only while the inflow exceeded the outflow. That dependency on new money is the defining feature of the architecture. The SEC's enforcement record and the criminal case described a system in which current obligations were met, to the extent they were met, out of incoming funds rather than out of the dedicated assets that were supposed to be standing in reserve. The reserves had been hollowed. The cash had been diverted. The policies were inadequate. What remained was a flow that had to keep flowing. Add the asset transactions that the record established. Trust assets and insurance reserves were not simply held. They were moved. The criminal proceedings detailed transactions in which funds that should have remained protected were used to acquire assets and to support the operator's other activities. The record established that some of these transactions had no legitimate business purpose connected to funding funerals. They served to move money out of the protected pools and into the control of the operators. By the time the structure is fully drawn, the org chart is simple and its danger is structural. At the top, the operators. Beneath them, NPS, the seller of contracts. Beside NPS, Lincoln Memorial Life, the affiliated insurer. Around them, the pre-need trusts, increasingly holding Lincoln Memorial policies rather than independent assets. Flowing in, the customer payments. Flowing out, the funeral payouts when deaths occurred, and the diversions to the operators. The protections that state law required, the trust and the independent insurer, had been merged into a single controlled system with no external backing. The total exposure, as the matter resolved, was approximately $600 million across the affected trusts and contracts. That figure represents the gap between what families had paid for and what the system could actually deliver. The question that follows from any architecture this large and this durable is the detection question. The arrangement operated for years. Pre-need contracts are regulated. Insurance companies are examined. Trusts have trustees. How did a structure with circular reserves and inadequate policies persist? Begin with the fragmentation of oversight. Pre-need funeral sales are regulated at the state level, and the regulator is often the state insurance department or a state funeral board, depending on the jurisdiction. NPS operated across multiple states. Each state regulator saw a slice of the operation. No single regulator saw the whole. A funeral board in one state supervised the contracts sold there. An insurance department in another state supervised Lincoln Memorial Life. The trust was administered under the law of wherever it was domiciled. The structure exploited the boundaries between these jurisdictions. A pattern that would have been alarming if viewed whole was, when divided among regulators, a series of individually unremarkable filings. Consider the insurance examination itself. The Texas finding in the cold open shows that the problem was, in fact, visible to a careful examiner. The actuary identified that the reserves were affiliated policies and that the death benefits would not cover the funerals. That finding existed. The structural lesson is not that the problem was undetectable. It is that detection at the examination level does not automatically halt a multi-state enterprise. An examiner's finding in one state's file is a document. Converting that document into enforcement that reaches the controlling operators and the affiliated entities in other states requires coordination that the regulatory structure did not readily provide. Consider the trustees. The pre-need trusts had trustees, financial institutions responsible for holding and administering the assets. The integrity of a trust depends on the trustee maintaining the assets in the form the trust requires. The record in the related litigation established that trust assets came to be held in the form of affiliated insurance policies. A trustee performing rigorous independent verification would have asked whether policies issued by an affiliate of the seller constituted appropriate trust assets, and whether the issuing insurer was solvent on a basis independent of the seller. The structural question is what the trustee was positioned to see and what it was contractually and practically empowered to challenge. The transactions that moved trust value into affiliated policies were the precise transactions that a vigilant trustee was supposed to prevent. Consider the audit and actuarial function inside the insurer. An insurance company must hold reserves certified as adequate. An actuary signs an opinion that the reserves will cover the liabilities. For Lincoln Memorial Life, the adequacy of reserves depended on the value of the affiliated policies that constituted those reserves. Valuing an affiliate's obligation requires assessing the affiliate's ability to pay. When the affiliate is part of the same controlled enterprise, that assessment is not independent. The reserve opinion rests on a valuation that the structure itself compromises. The Texas examination finding is the moment that compromise was named in an official file. Now state the detection failure in structural terms. For the fraud to be caught earlier, several things would have had to be true simultaneously. A single authority would have needed visibility across the seller, the insurer, and the trusts at the same time. That authority would have needed to recognize that affiliated reserves and affiliated trust assets are not independent backing. And it would have needed the power and the will to act on that recognition against operators in multiple states before the cash flow failed. The fragmentation of oversight meant that no single party held all three. The Texas actuary held the recognition, but not the multi-state reach. The trustees held a slice of the asset picture, but were positioned to administer rather than to investigate. The state funeral boards held the contract relationships, but not the insurance reserve picture. There is also the matter of the timeline. A pre-need fraud has a long fuse. The shortfall does not appear when the contract is sold. It appears when the customer dies, which may be decades later. During the long interval, the structure shows no operational failure. Customers pay. The occasional death is covered out of incoming cash. There's no run, no missed payment, no visible distress, because deaths arrive gradually and the inflow keeps pace. The very slowness that makes pre-need a useful consumer product makes the fraud slow to surface. A structure designed to perform years in the future can conceal its insolvency for those same years. The funeral home directors who sold the contracts were positioned at the point where the shortfall finally became visible, but only one death at a time. A single director seeing one underfunded payout might attribute it to the particular policy or the particular contract. It is only in aggregate, across many deaths and many funeral homes and multiple states, that the pattern becomes a fraud rather than a discrepancy. The directors saw the symptom at the moment of performance. The disease was in the funding structure they did not control and could not see. The unraveling came when the inflow could no longer sustain the outflow, and when the slices of the regulatory picture were finally assembled into a whole. The trigger was solvency. A structure that depends on incoming cash to cover current obligations fails when the cash stops or when the obligations are demanded all at once. The record establishes that Lincoln Memorial Life and the affiliated insurer entered insolvency proceedings. When an insurance company cannot meet its reserve requirements and its claims, state insurance regulators move to place it in receivership. Receivership is the mechanism by which a regulator takes control of an insolvent insurer to marshal its assets and address its liabilities. For Lincoln Memorial Life, receivership exposed the central fact the examination had foreshadowed. The assets backing the policies were not real independent assets. They were affiliated paper and depleted reserves. Once the insurer was in receivership, the structure could no longer hide. The receiver's task is to identify the real assets and the real liabilities. For an insurer whose reserves consisted of affiliated policies, that exercise revealed the circularity directly. The death benefits that funeral homes were depending on could not be paid in full because the reserves behind them were not independently funded. The shortfall the Texas actuary had projected became the shortfall the receiver had to confront. State guarantee associations entered at this point. When a licensed life insurer fails, state guarantee associations provide a backstop for policyholders up to statutory limits. The guarantee associations of the affected states became responsible for addressing the policyholder claims that the insolvent insurer could not meet. This is the mechanism through which some portion of the family's losses was ultimately absorbed by the broader insurance industry, because guarantee associations are funded by assessments on solvent insurers. The cost of the fraud, in part, was distributed across the industry through this statutory mechanism. The federal enforcement followed. The SEC brought an enforcement action, treating the conduct as a securities fraud given the nature of the instruments and representations involved. The Department of Justice pursued criminal charges. The criminal case proceeded to trial, and the record there established the operation of the fraud in detail. The diversion of funds, the inadequate policies, the conversion of trust assets, the transactions lacking legitimate purpose. Multiple individuals were convicted following trial. The convictions established, as a matter of judicial finding, that the structure was operated to divert protected funds rather than to fund the funerals customers had purchased. Walk through what the enforcement established about the mechanism, because the legal findings map directly onto the architecture described earlier. The record established that the operators controlled both the seller and the insurer. It established that customer funds and trust assets were diverted from their protected purpose. It established that the insurance policies were structured so that they would not cover the contracted funerals. It established that the system depended on incoming funds to meet current obligations. Each of these is a structural finding, not merely a moral one. Together, they describe a funding mechanism that was insolvent by design and that performed only while new money arrived. The bankruptcy and receivership proceedings ran in parallel with the criminal case, and they performed the asset tracing function. The total exposure was established at approximately $600 million across the affected trusts and contracts. The proceedings sought to recover assets, to assign responsibility among the institutions that had administered the trusts and provided services to the enterprise, and to address the claims of the families and funeral homes left exposed. The funeral homes themselves were caught in the middle. They had sold the contracts in good faith in many cases, and they remained obligated to provide funerals for which the funding had evaporated. The civil litigation that followed addressed how the losses would be allocated among the parties who had touched the structure. The sequence of exposure, then, runs as follows. The structure depended on cash inflow. The insurer's reserves were affiliated and inadequate, as the examination had found. When solvency could no longer be maintained, the insurer entered receivership. Receivership revealed the circular and depleted reserves. Guarantee associations absorbed part of the policyholder loss. Federal enforcement and criminal prosecution established the diversion and the inadequate funding as findings of fact. Bankruptcy and civil proceedings traced the assets and allocated the loss. The fraud collapsed not in a single moment, but through the orderly machinery of insolvency law, which is precisely the machinery designed to expose what a balance sheet has concealed. What does this case establish about the mechanism? It establishes that the protection afforded by a pre-need structure depends entirely on the independence of the entities within it. The trust protects the customer only if the trust holds independent assets administered by an independent trustee. The insurance policy protects the customer only if the insurer is independently capitalized and independently regulated. When the seller controls the insurer and when trust assets are converted into the controlled insurer's policies, every layer of protection collapses into a single point of control. The redundancy that the regulatory design intended is eliminated. There is no longer a trust standing behind the contract and an insurer standing behind the policy. There is one enterprise standing behind itself. It establishes that affiliated reserves are not reserves in any protective sense. An insurer whose assets are claims against its own affiliate has no external backing. The Texas actuary's finding was the recognition of this fact in an official file. The structural observation is that reserve adequacy cannot be assessed by counting assets without assessing their independence. A reserve composed of affiliated paper is, for purposes of protecting policyholders, no reserve at all. It establishes that fragmented oversight is a structural vulnerability. A multi-state enterprise that touches insurance regulation, funeral regulation, and trust administration can persist in the gaps between regulators, each of whom sees only a slice. Detection at the level of a single examination does not translate automatically into enforcement that reaches the whole. The recognition existed in Texas. The reach did not. In the period following these events, regulatory attention to pre-need funeral funding increased. States examined the adequacy of their pre-need trust and insurance requirements, the standards for what assets may back pre-need obligations, and the supervision of affiliated relationships between sellers and insurers. The National Association of Insurance Commissioners and state regulators engaged with the question of how to prevent the conversion of protected funds into affiliated paper. The Guarantee Association system absorbed a portion of the loss, which itself prompted scrutiny of how a fraud of this design could reach that backstop. The finding of this review is structural and narrow. The pre-need trust and the pre-need insurance policy are sound instruments when their independence is preserved. The fraud did not require a novel instrument. It required only that the independence be removed by placing the seller and the insurer under common control and by converting protected assets into the controlled insurer's paper. The protection failed at the point where two parties that were supposed to stand apart were merged into one. The actuary saw it in the reserves. The funeral director saw it in the payout. The receiver confirmed it in the insolvency. The mechanism was insolvent the moment the independence was removed. The deaths simply arrived slowly enough that it took years for the shortfall to be paid.